A stop order is a tool investors use to manage risk when trading securities in the market. Think of it as an automated instruction to help limit potential losses or protect existing gains on your investments. If a stock drops below your chosen stop price, the order triggers and becomes a market order to sell. Once the market price hits your trigger, the order executes at the best available price, which might differ from your stop price. A stop order is about the trigger event, while a limit order is about ensuring you get the price you want. Market and stop orders generally execute faster than limit orders because they prioritize getting the trade done over a specific price point. Remember that during fast-moving markets, the price you actually receive might be significantly lower than your stop price. Thanks for watching. Understanding order types is a key part of your financial journey. Please consult a professional for your specific needs.